more on this, we are now being joined by Mr. Ajay Bagga, market expert, who's joining me live on the show from Mumbai. Mr. Bagga, thank you so much for joining me here on the broadcast. What's your take on the fall in promoter stakes in Nifty 50 stocks in particular in December?
Yeah, there are a few reasons behind this. One is if you look at the last 10 years, corporates have deleveraged their balance sheets. And we saw that there was a lack of new issuance coming in. However, with the sharp growth over the last 10 years, corporates required new funds. So part of this is explained by growth capital being raised by infrastructure companies, by highly indebted groups, which came under observation because of some reports. So people like that have reduced their stake in a bid to shore up their balance sheets or get growth capital. The second has been what you referred in your segment, that promoters found the levels high enough and they have cashed out to some extent to invest into other options that were available. Some money has been taken off the table. Third, we must remember the government is about 10% of the market, the government holdings, and there also we have seen regular disinvestments coming in from time to time. And the fourth is private equity funds let go about 2 lakh crores last year in terms of disinvesting from their companies. So wherever these were already listed companies, you would see promoter holdings would have fallen. So yes, it is a caution when promoters reduce their holdings, but the reasons are more regulatory, more growth capital driven rather than an exit by promoters
Mr.
from the
Bagga,
markets.
now with the recent meltdown in the markets, what's your outlook for Indian stock benchmarks for March?
March is not looking too good. I think you will have a shallow bounce as we saw in the first hour today. Some amount of domestic good news is coming through in terms of a GDP recovery that we saw for December, but the global cues are still very volatile. So we are expecting March to be steady. 5 months of fall have happened, which is again a 29-year record we have set. Normally, after such a fall, the markets tend to stabilize. But right now, the global issues are too strong. So I would say still time to be cautious. We don't see a runaway rally anytime soon. That's at least 6 to 12 months away.
March doesn't seem too bright, as you mentioned, but any advice for retail investors in stocks and mutual funds sitting on huge losses during these times?
See, we have to look at our asset allocation, and I would say the incremental money, put some more money into fixed return instruments. That will help to even out your asset allocation. Selling at these levels in a structural growth story like India, it's not warranted. If you had to sell, maybe you should have sold earlier. If you want to create some cash on the side, say 5-10% can be sold. But I'm quite convinced that by the end of this year, the situation will be very different. And overall, India is a 20-year bull market in the making. Right now, even if the leading indices, which are at 15-16% down, if they cross the 20% and go into bear market, average bear markets last about 12 months in India. We have already gone through 5 months of pain. I would say 6-7 months of pain might be left if we reach a bear market at all. I don't think we'll reach a bear market, but even if that comes through, we might have 5-6 months more and then we resume our journey upwards. So this is not the time to sell. I would say just steel your hearts and don't look at numbers every day. Don't look at your portfolio every day. Just wait through this time. It's a waiting period, but not a period to sell. Because remember, when the recovery comes, market will give 1-year returns in 2 weeks to 4 weeks.
So sit tight, stay calm, don't rush into sell, sit tight because it's going to take a few more months after a fall like this. That's what Ajay Bagga is suggesting. Ajay Bagga, market expert, joining me from Mumbai. Always a pleasure speaking with you, sir.
Thank you.